Welcome back to Golden Rule Radio. Today is May 30th, Wednesday. We're taking a look at the markets this week following hot news coming out of Europe in the Italian bond market, which we'll touch on here briefly. The Dow continues to rise along with gold and the dollar and the other metals. So it seems like just about everything's going up while the euro continues to take a beating and the European Union faces some credit issues.
It's been very fascinating to watch gold react to that. Move in the dollar, move in the euro. You know, we're off 7%, as you say, from mid-April till now in the euro to dollar. And that's coming down from 1.24 to $1.15. Those of you who are getting a little frustrated over the lack of strength in the price of gold, relax. This is actually very strong, bullish territory, because remember last year, gold was up 13%, and that's because the dollar was down 13%. We saw a one-to-one move. So now when gold should be declining and it's not following one-to-one, that's very strong to me.
Yeah, Tori, it has been fun to watch all the markets, at least over here on this side of the Atlantic, moving up. I think we definitely should start with the Italian situation. I know David and Kevin went through this yesterday on the McAlvany Weekly Commentary, just discussing how the credit market has moved over there and some of the interest rate rises. I think they said the 2-year bond was up about 1.7% just over the course of a couple days. So while the euro has actually been falling since April, this isn't new information. I mean, this has been going on for a couple months now as the dollar's been rallying. We are seeing some additional pressure there in Europe, in their credit markets, that may just continue to push the euro down and may continue to push the dollar up to some of the levels we talked about in last week's show.
You had mentioned that 95 was going to be a resistance point. We just about kissed 95, 94.97 on the dollar index, and that's exactly what you had said last week. Anything indicating to you that we're going to break above that, or do you feel like that's sort of a pretty firm ceiling here that we're going to see hold?
I think for the next couple days, we're probably going to come back down. I mean, again, if you look at the charts, either the euro or the dollar, the euro's had maybe a handful of up days over the last few months. The dollar's the opposite, a handful of down days over the last few months. We've come into that pretty heavy resistance. I mean, that's going back to the dollar high from November or the euro low from November. So I wouldn't be surprised to see both of those markets turn around short term. We'll just have to obviously see how the Dow follows, how gold follows. So it makes you wonder, since gold and the dollar, thanks to the euro, have kind of been doing the same thing for the last week or two, it makes you wonder if they're going to diverge if the dollar pushes down for a short period here. I think gold is going to continue up. I think we're going to get back to the 1320s, 30s, 40s, 50s. And obviously, if the dollar comes down, that's just going to emphasize that.
You mentioned gold following, and I think that's sort of the key term. You mentioned that. You mentioned credit markets. Gold is following. Gold is a barometer, and we have to continue to remind listeners of that. It is not its own unique market that you should be frustrated as lacking in performance. It's telling you something. And right now, the fact that the gold price is holding with that dollar climb, to me, is saying it's really reacting more, as the World Gold Council inferred, to the interest rate hikes. So going back to credit markets, why are the credit markets strained right now? It's interest rates, it's debt. And, you know, all the news headlines yesterday with the Dow sell-off and the Italian tumult, and as the Wall Street Journal says on the front cover, that's spurring a global sell-off. Well, that was a one-day event, certainly, but that all comes down to debt, okay? The debt to GDP ratio of Greece, 180%. It's worse than Italy. We've talked about this since the 2008 crisis hit, and everybody was going back and dissecting it. Italy's at 131%, second in European countries. So is the problem going away overnight? No. Just because the market stopped reacting doesn't mean the problem's taken care of. What happens when you have significant debt and you're just a regular household running on a strained budget and your interest rates climb? All of a sudden you've got debt and they adjust your credit card interest rates, and now all of a sudden your payment obligations get far more strenuous. Same thing with your mortgage. Can you imagine if they were allowed to increase your interest on your mortgage right smack dab in the middle of your own little credit crisis? That's what we're seeing the world markets tell us. That's what we're seeing gold tell us.
Yeah, but that's not a fair comparison, though, Tori, because I can't just go home, turn on the printing press, and print up some extra Milos to pay off my extra mortgage.
Well, yeah, but the only people that can is the Federal Reserve. That's why the beauty of exporting the U.S. dollar as a world reserve currency remains a significant advantage for us in the rest of the world. Not every currency can do that. Europe is trying, right? They don't have quite the GDP globally that we have or that China has, and so they're at a little bit of a disadvantage. That's why China is strained. That's why they're trying to get recognition for the renminbi, because they want that same sort of privilege that you just alluded to. So sorry to kind of ramble on this subject, but it really is the key. And there's some hidden headlines here in the last couple of weeks that I really want the listener to go dig into. Okay, one is mortgage lenders are lending to strained borrowers again, unlike at any point since the economic crisis started to hit, since the housing market started to collapse. They're doing it in new ways. There's regulations that the banks have to get around. So the banks are now extending lines of credit to these mortgage lenders rather than extending credit directly to the borrower. All right, so there's a pass-through, and then the mortgage lenders turn around and sell that to Fannie Mae or Freddie Mac or somebody else whose balance sheet is just swollen incredibly since 2008.
So how about a double dip into the inflation pool right there? You're talking about the initial mortgage through borrowed money from the Fed, loaned out from the Fed to the banks, to the home buyer, into a mortgage that's then sold back to the federal government, which is probably the Fannie Freddie stuff is probably paid through inflated money anyway. So you have inflation on both sides of that transaction, the initial purchase and then the repurchase of the mortgage and the repackaging and everything we talked about, 10, 15 years ago during the housing crisis.
And just like what you're seeing in Italy right now, there's an increased risk now of default again, right? Doesn't mean that it's looming in the next week or a year. It's just saying, look, we're building that direction again, right? Well, now they're not only doing that to the mortgage borrower, they're also doing that to businesses. So now banks are lowering rates and easing terms on business loans. It's right in the left margin of today's Wall Street Journal. Why would they do this? They do it for two reasons. One, you can always count on greed, right? But I think more importantly, it's because they're getting desperate. They've got to keep the game going. So they have to ease terms, ease rates. So the Federal Reserve is raising interest rates, and yet banks are lowering lending rates. Now tell me, that's not a good recipe for success, in my opinion. That is telling me that they're trying to get more competitive because they have fewer callers calling to open new business loans.
So I guess the unfortunate lesson here is that no lessons are ever learned, because it sounds like we're repeating ourselves ad infinitum over and over again, as early as the 2008 crash. Moving over to some of the other metals and seeing how they're reacting to these markets, silver being less of a barometer to the health of the market than gold, certainly platinum and palladium as well. But silver has sort of just been sitting in this hangout zone here since what about March? We had one little kick up maybe a month or so ago, and it dropped back down.
It's really the only one that's flat.
Yeah, it's not really doing much of anything. I think it's waiting to see what the rest of the market's going to do. From a commodity standpoint, it's not surprising to not see it moving one direction or the other, because we don't really have a global commodity usage crisis, and we certainly don't have a glut of inventory that would cause the price to go down, but we don't have that fear or panic mentality from a non-commodity, from a currency standpoint that silver offers. People rushing into silver yet, because gold's still cheap. And that's the one thing we do see is when gold gets expensive, silver ends up getting way too expensive. So silver continues, in my opinion, to be the best opportunity in metals today, simply because it's so stinking cheap and it doesn't want to do anything yet. I think when this turns, when the dollar turns down, when the equities markets turn down, when people start looking at silver as a currency again and not just a commodity or a just precious industrial metal, then that's when I think we finally see this turn. But for the time being, enjoy $16 and X cent silver, because it's probably going to sit there for a bit.
At 1/80th the price of gold. We'll take it.
So rounding out the charts for this week, I do want to glance back at the Dow. We went through pretty extensively last week. But again, we're seeing a number of technical indicators that I think all line up with some of this news we're talking about maybe the euro bouncing for a short bit, the dollar pushing back down. The Dow has been down. The Dow just reached a support level here, a little short-term interim support level, obviously bounced up pretty hard this week off of that. So we're looking at a couple different indicators on the Dow, all calling for my number at around 25,400, where I think is our stopping point on the rise on the Dow. So I would expect gold to increase over the next couple weeks, the Dow to increase over the next couple weeks up to that level, the dollar to come back down, and the euro to come back up following the news reports coming out of Italy. You always have the buy the rumor, sell the news. The rumor's over. It's time to sell the news. So keep an eye on these markets as things progress and as the news and credit issues over in Europe shake out.
So if you're a regular listener, you'll know that we occasionally will get very specific on the recommendations, either based on value, based on ratios, or based on premiums. And right now, focusing on premiums, I would strongly recommend you call us at 1-800-525-9556, and we will reiterate the significance of the opportunity in the premium markets right now. We now see other firms jumping on the bandwagon, if you will, 5-6 months after we've started really pressing this issue. And just call us. We really want to educate you and help you understand how you can pick up ounces without putting more money into your precious metals portfolio. So things like U.S. double legals are very much worth considering, as are small European fractionals. And we have an incredible deal on Italian 20 lira right now that you should call us on.
You know, Tori, we've seen these markets cycle for a number of years, and to watch certain types of products, not just metals themselves, but certain products within the metals, cycle from severely undervalued to severely overvalued, and be able to make those changes at the right time, like you said, to pick up those extra ounces, is, to me, a easy strategy to employ over a long period of time. The issue becomes is every time you miss an opportunity, you miss a multiple of the next opportunity. So our goal is always to get people into these undervalued assets within this asset class. You know, we never want to steer away from the real reason you own gold, the real reason you own silver. And that's the first stuff we talked about today. That's inflation, that's government intervention, that's credit market issues, that's housing market issues, that's stock market issues. But if you can be within a safe asset like precious metals that's going to retain its purchasing power and value over time and get into the right product at the right time at an undervalued premium or an undervalued ratio like gold to silver, platinum to palladium, gold to the Dow, or high-grade rare coin $20 gold pieces compared to bullion, if you can get in and out of those coins and those products at the right ratios at the right time, like you said, you can pretty significantly increase positions and increase ounce accumulation over time. So I was talking with a client of mine this morning that I had worked with a number of years, and for me, what I want to see is my ounce numbers accumulate and compound over time. And when that happens, if you can turn 10 ounces into 20, into 50, into 100, it becomes irrelevant what the dollar amount is.
So thanks, Miles. Let's wrap it up this week. Appreciate you listening. If you like the program, please give us a thumbs up below.
And you can also click on that subscribe button if you want to come back and give us a thumbs up on a regular basis. You're welcome to give us a call anytime at 1-800-525-9556. If you'd like to speak with one of us personally, head over to Twitter at ICA Gold to follow any news we may have coming out. And of course, always swing by our website, McAlvanyICA.com. As always, thank you for listening.
Have a great week.